All right. Good morning, everybody. Let's go ahead and get a screen showing. All right. So OpEx is right around the corner. Option expiration is always the third Friday of the month, so it's easy to keep track of. There has been a massive call wall over our head for a while now, and the market just has really not been able to get through that 4,200 zone. We're going to talk about that a little later today. I've got a few options trades and a little bit of insight that, you know, for a little bit of risk might be worth the reward. So we do have some speakers today. President Lagarde is going to be speaking. Then we've got job numbers, home sales. We have additional auctions, and then we have a lot of Fed speakers in the afternoon. We've also got European central bankers coming in, chipping teeth as well. So we got a lot on the table. In the overnight tonight, it's a really big deal. Japan's got a lot of economic data coming in. So we could wake up to an entirely different day tomorrow. It just might be a little bit of excitement. There's a lot going on over at the ECB, the European Central Bank, and that is what is on everybody's mind and front and center. But I'm still looking at Japan. So we can see on the docket today, nearly every hour on the hour is another economic event, right? So when I say watch the clock, I'm not being cute with that. There's no, subtle meaning behind it. There's literally hundreds of economic events that come in all day, every day. Things that you don't even hear about because, well, news agencies have a tendency to focus on the shiny, glamorous object, and they don't really, hone in on things that might be useful or valuable. So, grain shipments, just the most minutia of data is constantly coming out, and we don't see even half of it in this list. But one thing we do know is everything is very methodical. So it's going to happen on a half hour or on an hour, right? Job numbers, unemployment numbers, grain weights, energy reports, oil reports, lean hog, go down the list. It's going to happen on a half hour or an hour. So, especially if you're trading in a small account, you're trying to use a tight stop, don't get in the trade at say 10:28 and then get run over at 10:30 because there's going to be just a little bit of volatility that comes in and wicks you out of your trade because you're trying to use a tight stop with a small account. Even just something as simple as that can help you avoid taking these small cuts that just chew you up and wear down that small account. Watch the clock. It's simple enough, right? Watch the clock. All right, here are your spot gamma levels for today. Kind of take your pick, whichever one of these you tend to play. Russell's on the far left, and then the SPY, the NDX, the SPX, and the QQQ. With the SPX, we also have the ES. So it's the same one. If you're loading it into your trading view, you can use number 1 or number 2 in your choice selection. Same thing with the RUT. Number 1 would be the RUT. Number 2 would be, using the futures, the RTY. Yeah, you like it. So here we're looking at Hong Kong. They closed down on the day and inside day, but they're still holding for the week. They've done exactly what we've done. Done nothing all week, like a hamster on a wheel. All that work and all that running around, right back where we started. We haven't done anything. For Japan, big gap down, but nice recovery back up, and they just like everything else, haven't gone anywhere. So at least they did manage to rally back up. What are you yelling at me for? My cat got attitude all of a sudden. Ah. And for Europe, it's 12:40. They're going to be coming back from lunch in about 20 minutes. They got this really small doji day at the moment. So red day yesterday, you really got nothing so far today. They've got a lot of economic stuff going on. So it makes sense that they're really not doing anything. They're waiting on that data to come out. And the dollar is still sitting inside of this channel, holding below that 102 level, and yet holding above 100. So, we're at this critical low, and really just like watching a car wreck in slow motion, keeping our eye on this thing, see what it's going to decide to do. Between this and the VIX sitting at levels that we haven't seen in years, the market is primed and ready for something wild. We're gonna come back to this. We're not gonna start here. I'll nerd out on you guys when I'm done with everything else. All right, so as you can see, 7:30, 8:30, 10, 10:30, 11, 11:30, 1. So all day today, we've got front end at the 2-year. We've even got things as close as the 3-month and the 6-month. And then we go a little farther out on the curve to 7 years. So we're all over the place. Full house. All right, we had a really narrow IB last night. And if we apply a little bit of Fibonacci levels, I mean, you can use the quant levels, Fibonacci levels. It isn't going to matter because we want 0 through 100. So for that, I'd rather use the quant levels. When I snap those on there, all I did is measure yesterday from its highest point to its lowest point. And that gives us 50%. And if we look at what happened when the market opened in the Globex last night, it dropped down and it just hovered back and forth at that 50% level until everything started to unwind in the kill zone at 2 a.m. So we were holding underneath that daily pivot point. We crossed down below the weekly pivot point, had an inside day breakout, and now it's trying to get back up in there. And it's holding underneath the VWAP. We've got some decent volume today, been holding above 100 for a couple hours now. In fact, I kind of feel that the volume slowed down a little bit after this move. So we are at ADR half, which is that solid red bar at 41.49. And the ADR full is at 41.25. So this is kind of the range we've been dealing with for a while, right? A couple weeks. We can really see that topping out pattern where we failed to follow through and get anywhere else. And there's no reason to kind of, get too hung up on it. But we had a little bit of a rising wedge there. It doesn't fit to be that big and that wide at the top of a zone like this, and then use it for, like measured moves and things like that. Patterns are supposed to show up at certain locations, and a rising wedge really just doesn't belong up here. So it's not to say that we would ignore it, just you'd have to take it with a grain of salt, right? Like approach with caution. I would certainly not size up if I was gonna trade this pattern. And we've seen the follow through, right? Because what we would do is measure this, and then when we get the breakdown, we would plot wherever that breakdown is at, and we'd mark 50%, and then we would mark 100%. We didn't even get 50%, which kind of implies that this breakdown that we got here on the rising wedge, that this rising wedge really wasn't that great of a rising wedge anyways. And that makes sense because it shouldn't be where we found it. Now, having said that, there is a little bit of analysis that says the rising wedge isn't done yet. So what we had here is the breakout, and instead of just following through in one shot, it made the breakout and then it gave us a Busby. And the Busby overshot a little bit, kind of got back inside the base, but now is the real breakdown. And that first one was just a little bit of a fake out, or the start of the breakdown, and maybe they tried to defend it. So something to consider. I'm still of the mind that it shouldn't have been up here in the first place, and that I don't really want to give it a whole lot of trust. But I am willing to keep an open mind to the idea that we've seen this kind of a breakout on a rising wedge before, and we still ended up getting the follow through afterwards, after we got the Busby. So with that in mind, what you do is measure from where the Busby is, right? From the pullback retest and the new breakdown. This is the distance from that rising wedge. If we cut it in half, 50%, and it's kind of hard on Thinkorswim because it doesn't give you, what do they call them? A grip in the middle. So, you bring out a drawing tool and just measure the line that you already made. 50% right there. So we've made our measured move now. That's all that it owes us, is that 50%. If we get more, 100% of the move would bring us down to 41.12. There's a cog line at 41.11. And, I just kind of threw these on here. They're not exact. I would say that measured move takes us to the 41.11. If we get 100%, we've already made the 50%. So it's kind of given us all that it owes. 10-day, 30-minute volume profile. When we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. We are underneath the point of control, and we've run back up through that zone a few times now. Nothing up there in that point of control or in that volume has acted as support. Not even a little bit. We were able to fall right back down through it, but it used to be a resistance, right? We can see back here when we were running up into that zone, we were hitting a significant level of resistance. Then we finally got through it all, and we were able to come back through it relatively easy each time. So it kind of goes with that same thing on the premium and the OpEx that's coming. It's my notes from a little while back. This was posted on the 13th. Something that I've been keeping my eye on. When we were 9 days away from OpEx, Spot Gamma had wrote this nice little article and had gone into how the bulls are basically trapped because there's all these institutions that have calls and they want out of them damn calls. OpEx is coming. We're in the last week. Those things are going to decay like crazy. So any push up into that 4,200 area, the institutions are selling out of their calls like crazy. We can't get past that zone if the institutions are sitting there just selling it. So it creates this massive ceiling. They use word wall because the call wall sounds better than a call ceiling. But there's really no way for the market to get through that area. And every time we go up into those highs, there's the institutions with bucket loads of calls that they're just dumping on our head, right? And it's been that way since the 13th. So we got today and tomorrow, and we're going to be through that. We'll be on the other side of it next week. But that doesn't mean that it won't try to go up into that area and get those rejections, right? All right, so we carried forward the VPOC from Tuesday into Wednesday's markets where I drew it out. We came up into it yesterday afternoon, took it out. So we're done with that. But the point of control from yesterday lines up really nice with the point of control from the day before. They're almost laying on top of each other. It shows that 4180 area has a significant amount of eyeballs up there, right at that level. So we're just going to bring the VPOC from Tuesday over into Wednesday. And now we've got a VPOC over our head again. So it's where these runs have been coming in, right? Where we set a low and they monetize the puts and they run everything up, trying to get it up high enough so that they can get out of some calls. Same thing again. And then same thing again yesterday. They're doing everything they can to get out of that stuff. It wouldn't surprise me if we get another push, which kind of is going to lead me over to the SPX and some options talk here in a few minutes, but we'll finish getting through here this first. All right, we are now finally below the 10-week and the 10-day, excuse me. And what that tells you when we're this close, put the 10-day moving average on your intraday chart. I mean, seriously, we hit it. We're there. We're at the 10. So you're going to want to know when price is interacting with that thing. So we can see we hit the 10 yesterday, bounced off of it and rallied back up. We hit it either late last week or early this week. Bounced and rallied, crossed over, and then rallied back up. So we interact with that 10 all the time. We're underneath it now. If we're going to get any sort of a rally today and maybe get back inside of yesterday's level, one of the things we're going to have to do is negotiate with that 10. I am on a daily chart. So this is a 10-day moving average, but we need to see this on the intraday charts, right? So when we come in here, this 10 is now a 5-minute 10. It's not what we need, right? So go back to the beaker and just type in the word daily and you get your daily SMA. Now that cyan line is the 10-period daily moving average. And you can see how we're underneath it and we need to negotiate with it. This is one of the things that doing a top-down approach gives you, right? That you go through with your notes, examine the different moving averages, recognize what we might hit today or what we did hit yesterday. Kind of ask the question, are we moving towards something or are we moving away from something? So we are below the 10, but we're right at it. So we're not oversold, we're not overbought, we're right at the start. The analogy I like to use is we're in the center of the basketball court. The game starts here. And from here, we can go to one side of the court or the other. So we can extend beyond the MA to the upside or beyond it to the downside. And that's going to lead us over to that options trade that I keep referring to. All right, so the financials are down a little bit, not really all that much, but enough. 50% is my line in the sand for, how far something has to move in the pre-market to get my attention. I've considered making that 1%, but really, this is going to be the sideways year. And I think getting 1% pre-market moves in a lot of names is not going to be something we see a ton of this year. So I'll just keep my benchmark in the same spot. Not really much out of K-Web. We're not seeing anything good in the semiconductors. Bitcoin's down 2%. Energy's down more. That USO trade that we put on is doing fine. They're not monetizing all that well, but price-wise, the trade is doing good. And nat gas is down again. Gee, what a surprise. Emerging markets are kind of flat. And yeah, gold's up a wee bit. All right, so we can see how the 10-year came off of that 365 area, 363. So we're still just kind of holding the line here, holding the level. Across the board in the dollar, yields, the VIX, everywhere and everything that we look at, the entirety of the market in the broader scale is just holding its breath. The VIX got down to levels that we haven't seen in a long time. It's very cheap. And I mentioned this the other day too, how cheap it is right now to buy insurance. All right, so here's the SPX. And we've got the weekly expected move on right now, which is nice because it shows us 1 week of price action. Right? We don't have to go out to the weekly chart. We don't have to count candles. We can just look at these lines and realize, oh yeah, that's 1 week. And I was listening to Don talk last night, and he brought up a point that I had heard him say before, but I hadn't really thought of in a while. It's very rare when the S&P doesn't get at least to the edge of the expected move at some point during the week for multiple weeks in a row. It can happen 1 week. Sure, no problem. I mean, that's not a big deal. 1 week? Yeah, cool. Fine. 2 weeks? That's stretching it. 3 weeks? There has not yet been 3 weeks in a row where we ended the week without having touched the edge of this expected move. Ever. As far back as the indicator works. So I don't want to say that it can't happen, that we couldn't end the week 3 weeks in a row without having touched the edge of that expected move, either to the upside or the downside, because it's absolutely possible that we don't hit it. But it's very, very likely that we're going to hit it because we've never had 3 weeks in a row where we didn't at least touch the edge of the expected move. Now, granted, this indicator isn't as accurate as drawing the lines. And it's very possible that you could use just the indicator and go back and see where price might have hit one of those lines with the indicator. But if you had hand drawn the lines every week, it hasn't hit those, and those are more accurate, right? This can't necessarily represent what it's supposed to represent. What it's representing is the average implied volatility here in a measured move. The person who coded it, Mobius, I think he did a pretty good job. But on Thinkorswim, you can't access this data with a code. Right? So he had to come up with these numbers without actually reaching into this area and getting those numbers. So it's not exactly 100% accurate. Still, the question is for this week, if we were going to hit the edges of the expected move, how would we want to play that? And is there a way that we could play that trade where we can play both sides and maybe keep the risk down a little bit, right? When I've got high conviction, I don't mind taking risk. But we're range bound without any real bias for an upside or a downside move. Where's my conviction to go with the upside or with the downside? I don't really have any conviction. So I don't want to put on a big trade, big as in big risk, but I still want a trade that has a nice payout. Otherwise, why am I wasting my time with the trade? I mean, it's got to at least pay me something. The cool thing with options is you can get a really big payout with a very small risk. And generally it goes down to, a snowball's chance in hell, like a lottery ticket. A lottery ticket can pay you a whole lot of money for very little risk, but you really have like no chance of winning. So we want to increase our odds of winning by targeting these two lines and then put the trade on. One of those two is likely to monetize. Why? Well, because it's Thursday. So between now and tomorrow at the close, we're expecting price to either go up to 4,100 or go down to 4,076, 4,200, excuse me. One or the other. And, honestly, it could do both. Nobody's saying it's a binary event here. Price can do whatever the hell it wants, so it actually could hit both sides. I don't think that's a very realistic scenario, but I mean, it could happen. So if we were to put on that trade, what would it look like? couple ideas that I was coming up with. Just your regular butterflies. I made them kind of wide, $10 wide. So using 4,200 with 4,210 and using 4,200 with 4,190. It's $10 either direction on the butterfly, and it's 10 cents. I think we could work the order since we are talking about the calls and the market is down. I don't know how well the options free market price is actually, how accurate it is, but I think we could work that order and make it 5 cents. In the SPX on the options chain, it might show you a 1 penny trade, but that 1 penny trade will never fill, so don't waste your time. The SPX is a nickel increment option. You can't penny fill on that thing, so don't bother. Always try to get at least 5 cents or 0 if you're doing some kind of spread. You can fill trades for 0, but you won't fill it for anything less than a nickel size number, 0, 5, 10, 15, 20. That's just the way it is. The S&P is not a penny increment option. So I think we could work the order for 5 cents. And if we can, I would also consider widening this out even more. So if it does price for 5 cents when the market opens today, instead of making it $10 wide, I would try to make it $15 wide and see what that price is for. And then of course, work the order, because both of these could lose, and combined, we're talking about a max loss of 20 cents. I mean, I don't like to lose, but I guarantee you I'm not going to lose sleep over 20 cents. But if we can keep that small, let's keep it small. So make the trade wider if we can, and still try to fill for 10 cents or less. Same thing on the put side. Puts are always more expensive than calls. So I did go 10 wide, but I had to work the order to make it 10 wide. It wasn't pricing it at 10 when I built it. So, you know, and they're probably going to be more expensive since we're opening down this morning. It's going to be a lot harder to get that butterfly on at a cheap cost as wide as we have it. And what I honestly think is going to end up happening is we have to make this one smaller if we're going to keep it around that 5 to 10, maybe 15 cent cost. So unfortunately, the put butterfly is just going to cost more money. I'm really looking at a 4,200 and then a smackdown. That's kind of my, secret little heart of hearts. It's kind of what I've got in mind. That we make one last hurrah to the upside, and the market makers monetize, dump those calls on our head again, and down we go, because they want out, right? They want out of those 4,200 calls. So I think they're going to get their chance. When you're the one driving the boat, you can steer it where you want to go, right? All right, so outside of that, we've also got just your regular everyday run-of-the-mill iron condor. I used the same spreads from up here. I just took half the butterfly off, which, speaking of, depending on your broker, if you have 2 butterflies on, the put side and the call side, and they're built like this, if price is still sitting in the middle of those things, you can tear apart the butterfly and build yourself an iron condor. So something to consider. This iron condor carries a lot of risk. It's $10 wide, and we're looking at $1.30 in credit, which means we're risking like, what is that, 770? No, 870. Risking 870 to make 130. That's a lot of risk. So, I put it out there just because of how far apart everything is, but I don't like this kind of skewed risk reward. In the options world, they say it's appropriate because it has a very high win rate. So they say, no, it's okay to, risk 8 to make 1. I guess that doesn't mean I got to like it. And then I was working on a broken wing butterfly, and I wanted to add a sling. I just haven't quite decided what that sling is going to be. So with this broken wing butterfly, you're risking about $65. And it has like an $1,800 payout. which is really nice. Maybe 1,400 to re-examine it. So your max loss is at 65 cents on the call side. Well, if that's my call side risk, all I got to do is try to eliminate $65 worth of risk. Like a put credit spread could eliminate some of that, or a put maybe a put calendar, something that can help reduce this 65 cents. So just to kind of give you a visual of the trade here. That's both of them, the put side and the call side. But let's not confuse things. Just look at one here. So this is the call side. This really needs price to run up into that 4,200. And of course, if we get a little bit of an overshoot, right, then we're looking at about $1,950. That's not bad, yeah. And that's $50 of risk. We can see the call side's just really cheap compared to the put side. And if it overshoots 4,200 and just goes to the freaking moon, you're still going to get paid. It won't be as good, but you're going to get, 450 in that one. So you don't have to worry about it overshooting and then giving you this big, massive loss. If it overshoots, you still win. You're only going to lose if it doesn't rally at all, or if it can't rally and get above that 41.85. If it stays below that 41.85, your max risk is the $50. I like that. Plus, we can tear this thing apart, right? We can absolutely rip it apart, because what is it? It's two vertical spreads. It's a call debit spread and a call credit spread. Then we've got the same thing on the put side. 40.80 is the line in the sand. It's really the low edge of the expected move. It's kind of closer to 40.75, but whatever. So with this one, max risk is $1.40. Yeah, it's a lot bigger. And I still want a way to reduce that number. But if we don't fall, that's your risk. If we fall through it and keep going, you'll still get monetized on the other side, about 350. If we hit that 480 edge of the expected move, you're looking at $1,300. I mean, it's not bad, right? The risk to reward in this is really nice. An iron duck. Well, that's interesting. I hadn't heard of that. And I've seen some funny names, the Cockroach Motel, now the Iron Duck. I mean, in my mind, I've got this visual that they just sit around the table taking shots and scribbling different names on pieces of paper. Right. And then when they're done taking shots, they got to reach into the hat and pull the name out, and whatever the name is, that's what they call it. Yeah, it probably all does sound very Greek. The idea here is when it comes to options, we don't have to trade directionally, and we can trade neutral. But neutral doesn't have to be where we're at. We could be bullish neutral or we could be bearish neutral. And this trade on the call side is bullish neutral. We're saying, I think we can run up there, and then we'll monetize if we're there. The put side, we're saying, I think we can run down there and we'll monetize if we get there. So it won't make money if we only just start going in that direction, and it won't make money if we start going in that direction. And actually has to get there like a bullseye. Getting close to the bullseye doesn't count, right? You got to hit the bullseye. What makes a butterfly even a little more tricky than that is it has to get there in the right time. It's kind of like meeting somebody for coffee. If you're supposed to meet them at 9 o'clock and you're there at 3 o'clock, you might have been in the right place, but you weren't there at the right time and you failed. So with these butterflies, it has to be there in the right place, and it has to be there at the right time. And that's what makes them so difficult. But there's always a way to game the system. So that's what we're looking at here. I don't yet have a sling a sling would be a way to reduce these dollar amounts. Even combined, you're looking at $1.70 at that price. And that's not bad considering, combined, we were looking at what, $2,700 for $1.75 of risk. Obviously, it would be a very rare thing to monetize both of these trades. I would say almost impossible to monetize them both. So one is going to win and one is going to lose, or they're both going to lose. Because you can definitely lose both. But if even one of these does win, it will more than make up the loss of the other one. More than make up the loss. So that's not the issue. The issue is just since both sides can lose, and this is a little bit of a YOLO play, right? You only live once, just throw it out there. There's no conviction in it. And when there's no conviction in a trade, I find it hard to size up and put money at risk. Because it's not like there's momentum behind it or trend or anything like that. This is quant trade 101 stuff, right? We're literally just nerds geeking out on the idea that there's an expected move here that we haven't hit yet, and that historically we don't go 3 weeks without touching one of these two lines. I guess that makes sense. The same thing with the butterfly. They always said that the butterfly looks like the body and then the wings. I don't see a butterfly when I look at a butterfly, but well, whatever, right? Like if it looks like a duck's head, there's the bat trade too, which is, turn both of these back on. Cat's ears or bat ears, or I heard that on Tasty. And then, there's the jade lizard. That's another tasty trade. There's all kinds of goofy named stuff out there. The cockroach motel is the one that freaks me out. Yeah. Couldn't have come up with a better name than that. Come on. So these prices aren't accurate. The market's not open yet, so we never trust pre-market options prices. These are just a ballpark idea of what the price or the cost would be. When it comes to those butterflies, the first two that I discussed, you really want to work the order on these things, because if you can get them for 5 cents and you can widen them out even more, you absolutely want to do it. You want to make these things as wide as you can make them, because that is the bullseye that you're aiming for. So right now we're looking at about a 10-point spread from 41.90 to 42, and then from 42 to 42.10. So put the two together, it's a 20-point spread. Price lands anywhere in those 20 points as we get into the last hour of the day tomorrow, and you're looking at some nice returns. About $1,000 for this one, risking 10 cents to make $1,000. Yes, please, just sign me up. But if we can make the trade wider and reduce the debit, then we want to do that. And on the call side, we might have that opportunity since we're going to be opening down this morning, right? That'll increase the likelihood that these calls are going to get even cheaper and that we can widen the trade out even more. So to widen it, instead of 41.90, we'll go to 41.85. And for 42.10, we'll go to 42.15. Let me unlock it and see what it's pricing at. $30. But now look how wide we are, right? From 85 to 15. It's 30 points wide, right? And what's our max risk? $30. I'd say we could work the order on that and get it down to 10, maybe 5 if we fall far enough fast enough and you can, pick them up before we bounce off whatever we're going to bounce off of. So something to consider. The put side is going to be more expensive, hands down, no way around it. No matter what you do, that thing's going to just be more expensive. It's at $35 right now for that $10 wide put spread. But when we begin to rally up today, if we rally up today like we did yesterday, the put side in the rally, say like during this part of the rally on Monday, When this kind of move is happening, those puts are going to get really cheap for a short period of time. They're just going to dump in value. And that would be a good time to put it on, is during that rally. Put the put butterfly on. And of course, you don't have to put both sides on. You could just put one or the other on. There's a trade I called the Marcus a long time ago. I had put this together. And what it is a double diagonal on each side, right? So a double diagonal on the call side, double diagonal on the put side, and it put your break evens another 25% wider than the original width of the box. I kind of like that, but it takes a lot more buying power reduction, and it does leave you exposed to getting run over. And since we've been range bound for 3 weeks, when the move does come, I'm expecting a pretty nasty move. So I don't recommend doing any range bound trade like an iron condor or anything like that that has a deep loss on the outside of the box. See, with this trade that we're looking at here, if we got overrun to the upside or the downside in these broken wing butterflies, if we got overrun, it wouldn't matter, right? Because we'll monetize. We'll see profit if it overshoots. If you put on just a regular iron condor and you get overshot, it's going to hurt, right? That's where the pain comes in. Here's your regular iron condor, and all this loss is on the outside of those wings. I'm telling you, 3 weeks now where we have not come outside of that box, when the move comes, it's very likely going to look like that. Here was the box, and it exploded outside of the box in a 2 standard deviation move. Don't put on a trade right now that says, I bet you won't move, because the market's going to say, hold my beer and watch this. All of this aside, today is going to be very likely a difficult trading day with all of this stuff on the agenda. Unless all of the stuff on the agenda actually lines up and is all positive or all negative, and instead is a collection of kind of wishy-washy data and a little bullish data and a little bearish data. If it's a pixie stick mess of data, we're going to just have a yo-yo wild trading day with random reversals, big ups, big down, volume sweeps coming in, block trades coming through. I think it's going to be a very tricky, difficult trading day. Unless it all lines up, right? If it's all bearish or if it's all bullish, then yeah, sure. But there's going to be Fed speakers behind all of this too. So not only do we have all of this data, we've got a lot of Fed speakers today from around the world. Everybody watch the clock today, right? Watch the clock. Be careful, be safe. I'll see y'all tomorrow.